company decides to pay this month's total employee salaries was 200 the following month. So this happens in many countries, but there's not much to do, rather than just complain. It's one of the things that's very frustrating. So what happens from the company's perspective? What's going to happen? First of all, can you recognize this as expense? Well, the answer is yes. Even if it's not been paid yet in actual cash, we can recognize this as expense. And in this case, labor costs, employee salaries could be, either SG&A or cost of goods sold. We just put it under SG&A just for visual purposes. Thus, EBT will be down by 200 because it's an expense, it's a cost, and net income would be down by 200. Again, we are assuming no tax rates. We're going to start from a negative 200 on the cash flow statement, and retained earnings at year end would be decreased by 200. However, there wasn't a cash outflow from the company's perspective yet. So changes in cash in the end is 0. Thus, we have to make adjustments. We have to make a positive $200 adjustment. Is wage, employee salaries, cash from operations, investing, or financing? We can easily figure out that it's from operations. So we're going to increase wages payable worth $200. And similar to accounts payable, wages payable is a liability. Also often included in working capital calculations as well. But anyways, the cash flow statement has now been adjusted. And we're going to send changes in cash. No changes are going to be made. We have to balance off by adding $200 to wages payable. So in the end, assets equals liabilities plus equity. So operating expenses worth $200 is recognized in the income statement, either in COGS or SG&A. Net income is down by 200. However, we can think that no actual cash has been yet paid. Thus, a $200 adjustment is required, and that adjustment would be written increase in wages payable. It's an increase in liabilities, thus a positive adjustment. Coming back to the balance sheet, no changes in cash, $200 additions to wages payables, and a $200 decrease in retained earnings will balance. The next year, when the cash has actually been paid to the employees, everything goes the opposite. Nothing is going to be happening in the income statement because we have already recognized expenses last year. So we're going to start from 0 and no changes to retained earnings. However, $200 worth cash outflow is going to happen. So we have to make adjustments. We're going to do exactly the opposite of what we just did before. So there's going to be a decrease in wages payables. So decrease in liabilities is going to be a positive adjustment on the cash flow statement. Changes in cash worth 200 minus 200 would affect cash balances at year end, and wages payables balance would decrease by 200 as well. So the assets and the liabilities and equity side would match. So this is going to be pretty much very similar to other kinds of payables transactions as well, such as accounts payables. We're going to do the exact same for accounts payables and for other expenses where cash outflow is later than the actual expense recognition.